let's bring in our panel for reaction. Ed Lee from the New York Times is joining us. Alan Gould, analyst at Loop Capital, joins us now on the phone. Alan's got a buy rating on the stock. Mike, just want to come to you first on this. The stock kind of holding up, despite what is a headline miss on the key subscriber ads. But on the US side, they had fallen last quarter. This quarter, at least they're adding, even though adding less than analysts wanted to see.
Exactly. No, I mean, it sort of confirms the idea that I think people's sights had been lowered well beneath where guidance was still sitting for the company. Pretty much came on target in terms of what the street was looking at, and even the fact that the stock is holding up in the fact that they're guiding down versus street expectations for Q4, it tells you the stock is taking some punishment right now. Maybe they believe it's now a conservative guide as opposed to an ambitious one, and maybe some steady state. Now, their earnings outperformance, it's funny because I don't think the stock typically trades on that. You have to see exactly where that came from, if it's a marketing spend or something else. But that's something that you might also have as a wrinkle as people revise estimates.
Yeah, 43-cent beat there on earnings. Again, not something we focus on.
On a revenue match.
Right,
so, yes.
Exactly. Ed, I know you have been digging through these numbers.
Right.
What do you see here that you either like or don't like as we watch the stock reaction bounce around here after hours?
I mean, I was looking more closely at the Q4 forecast, right? Because that's when, we're going to get the Disney Plus, we're going to get Apple Plus in 2 weeks, and then a week after that, Disney Plus. So they're anticipating that competition. I actually think their forecasting is clearly getting better. So even though it missed the estimates in terms of what analysts were looking for on that, I think, it's still positive for them, right? That's still a positive narrative. That even in the face of this competition, they're projecting 7 million plus new ads for this quarter.
Alan, are you surprised to see plus 5% after hours moves, given that there was a bit of disappointment on the subs numbers, both this quarter and the guide?
Yes, Wilfred, I am a little bit. But the one thing is, this is the first time that the consensus estimate was less than their guidance. So the street was set up, the stock was set up to be able to handle an earnings miss. But I am a little bit surprised that the 4Q guide is 7.6 million versus 9.5 million consensus, which implies this will be the first year that net ads don't grow quicker than the prior year, and the stock's still up 5%. But we do like the stock. The stock's come down 22% since last quarter. And you can go out to 2021 or 2022 and start valuing Netflix actually on multiple of earnings.
Alan, do you care at all about the EPS or just the subs at this stage of this company's lifespan?
At this stage, the subs and the free cash flow, and by the way, free cash flow was a bit better than expected. I think it was about minus 550. The street was expecting closer to minus $1 billion. I'm not sure what the guide is for the fourth quarter yet. I think the most important thing, though, is you can look out and project reasonable earnings going out 2-3 years. That allows you to value this as a multiple of earnings.
Let's get back to Julia, who's been digging through the release. Julia.
Well, CEO Reed Hastings here talking about competition and the launch of all these new services, Disney Plus, Apple TV Plus. He says the launch of these new services will be noisy. There may be some modest headwinds to our near-term growth, and we've tried to factor that into our guidance, saying in the long term, though, we expect we'll continue to grow nicely given the strength of our service and the large market opportunity. He also talks about the success of the lower-priced mobile plan in India and how they're experimenting and continuing to test mobile-only plans in other markets, also how they're working on the partner-based bundle offerings with Sky Italia, Canal Plus, and others, trying to make sure that it's sort of baked into those cable bundles. And then also just want to note one thing here about operating margins. They say they're on track to achieve full year 2019 operating margin goal of 13%, and that next year they'll be targeting another 300 basis points in operating margin expansion. So it really seems here with the stock up over 5%, like investors are seeing that the company is baking in concerns about all those new competitor services into its guidance for Q4 and beyond. Guys, back over to you.
Julia, thank you very much. Alan, if we can go back to you on some of those comments there from Reed Hastings saying only modest headwinds to near-term growth. Do you think the competition is going to be a little bit more than a modest headwind?
Well, I mean, keep in mind, Disney Plus is only launching in 5 markets in November. I mean, clearly the U.S., which is the largest market, and that's probably why the company's got very modest sub growth of only 0.6 million projected, despite a very, very strong content slate for the fourth quarter. And Apple TV only has, I believe, 9 shows on launch. So it will be messy, but we continue to believe that most people have 3 or 4 streaming services, and Disney and Netflix will be sort of the 2 two most dominant streaming services most people have.
Keith, very quickly, your take on this jump in the share price?
Yeah, I mean, it's really stunning to watch as we're talking about all the metrics and everything that's going on in here. One of the things that I caught in the analysis, though, of the press release is how they're going to have fewer subs than projected. They're still growing their subscription base, but their operating margins are going to continue to expand, and I think that's a really important thing. And also, Alan pointed out something that when you look at tech companies, especially earlier in their development, even when they have large revenues like a Netflix, it is about operating free cash flow. And if they continue to show a trend improvement there, then the stock price will be rewarded as a result, regardless of subscribers coming in, regardless of the bottom line.